I think money is starting to flow into silver as opposed to gold, a preference there. It's shifting again, and the miners versus gold. And I think between now and the end of the year, now I'm not looking for a top then, by the way. Don't confuse what I'm saying. I'm just looking for this particular surge to reach those levels. Ultimately, if silver went to $200 an ounce, it would not surprise me in the least. And frankly, if you go back in real dollar terms, factoring in the growth in the money supply, for example, and looked at 1980 when it was 50 bucks, or look at 2011 when it was 50 bucks, to match those highs in real dollar terms.
Silver is entering what could be its most aggressive acceleration phase in over a decade. Michael Oliver's latest momentum-based analysis points to a decisive shift in investor preference from gold towards silver, not as a short-term anomaly, but as a structural trend that could redefine the precious metals market in the months ahead. His data-driven view places silver in a potential trajectory well beyond $50 per ounce by year-end, with an extended upside that could challenge the real inflation-adjusted highs last seen in 1980 and 2011. In that context, $200 per ounce is not an outlandish figure, but rather a logical recalibration when monetary expansion is factored in. Historically, gold has dominated investor flows during periods of financial uncertainty, but Oliver's work indicates that miners and silver are beginning to outperform even as gold maintains stability above critical price thresholds. He notes that this leadership shift is emerging at a time when U.S. equity markets are showing signs of internal weakness. For investors paying attention, this is a critical inflection point where positioning early could capture the asymmetric upside of silver's breakout. This divergence is unfolding against a backdrop of central bank policies that have repeatedly inflated equity valuations, creating a psychological bubble sustained by rate cut optimism. Oliver draws attention to the historical precedent. The Fed's first cuts after prolonged hiking cycles in 2007 did not revive markets. They marked the beginning of protracted declines. In both cases, gold became one of the primary refugees for capital exiting equities, and this time, silver appears poised to take a larger share of that flow. Equally important is the absence of traditional fixed income alternatives. In past equity downturns, U.S. Treasuries provided a safe haven bid, with yields falling and prices rising. But today's bond market remains structurally weak, with long-term Treasuries trading only marginally above their 2022 lows. This leaves precious metals, particularly silver and the mining sector, as the clearest high-conviction alternative for both institutional and retail capital in search of defensive positioning and upside potential. In this analysis, we'll break down Oliver's momentum-based reasoning, explore the macroeconomic triggers he believes could accelerate capital flows into silver, and assess the broader implications for gold, miners, and the U.S. economy. If you value data-backed market insights and want to position yourself ahead of potential structural shifts, make sure to subscribe and stay until the end of this video.
If you had to pinpoint one major market event or trend that investors are underestimating in, let's say, this year, what would it be and why?
In fact, for the last 10 years, gold and related, okay. If you actually go back and measure where gold is now as a percent gain from where it was 10 years ago, 5 years ago, 3 years ago, year to date, and do the same with the S&P 500, you'll say, well, gee, what was I doing chasing the stock market? Gold is outperformed, and yet it's, from the data points I can see, and I don't focus on this that much, the contrarian opinion issue, but, you know, especially American investors are minimally invested in monetary metals. They still have the phobia, the desire to be in the stock market, the frothiness, which I think is going to chop their heads off. In fact, it's underperforming gold already. So, you know, wake up. That's why that's the case. I'm not sure. I think that central bank interventions, monetary excesses, rate cuts at the right time attract investors. And the problem is with that, when the Fed, for instance, there's a lot of talk right now that the Fed is going to cut in September. In fact, I think it was J.P. Morgan just put out a report that said they're going to cut 4 times this year. Nothing timid. I've seen some analysts predict that September will be a half-point cut. Not a quarter. Okay, so that's like drugs in the arm for investors. Oh boy, the party's on. But if they just do their history, we just put out a report that's not a technical report, it's just a historical observation. We showed the 2000 stock market top in the US. We showed the 2007 stock market top in the US. Just a price chart, nothing sophisticated. And then we show that there was a pause in rate hikes prior to them cutting rates. So there was a period after they'd been raising rates and then quit for like a year or so. Especially in 2006, they quit raising rates, and we got all the way into late 2007, and they cut rates. They started cutting in September 2007. 3 weeks later, the market peaked and went into bloody hell for the next couple years. Same in 2000. 2000, there was a pause. The market flopped around. We'd call the top, but it didn't actually top. It sort of floundered sideways. Early 2001, the price action of the market started to slip a bit. January of 2001, which was actually about 6 months after the actual traded high in the S&P. Fed cut rates twice. In other words, they commenced rate cutting. So the party's on, right? If you sold that rally, it was a tombstone. In fact, our report is called Tombstone. We put a tombstone on the chart, 2001 and 2007, where the Fed started cutting rates. And right now we hear a lot of that, and that's probably what's fueling this slight move out above the early year highs in the S&P. I think that's going to fail, and when that finally fails in a way that people notice, more and more money from the average American investor, who's very lagged into gold, will suddenly say, hey, you know, I need to find some other place to put it. And they're already starting, you can see it, the gold miners. They're starting to vastly outperform gold. Something's going on there. Somebody's noticing. And so I think these two factors are what you watch, the breakage in the bubble, stock market bubble, and the money flow out of there into the usual alternative. Well, usually when the stock market tops, 2000 to 2002, 2007 to 2009, there were two alternatives, primary alternatives for asset managers or investors to be in: gold and T-bonds. T-bonds rose in price, dropped in yield. That has not been occurring this time. The T-bonds, they're having a little rally right now, but if you look at since late 2022, the price has gone lateral in the sewer. It collapsed in 2021, 2022, yields went up, and you've really had no relief in terms of yields dropping or price rallying. And right now, T-bonds are all of 4 little points off their recent low. T-bond futures, I'm talking 30-year futures. So there really not been an alternative, whereas gold has been driving north. The question is, will at some point the U.S. government debt market, which we know is in a crisis potential situation, that's the way Jamie Dimon describes it. He says this time around, it's not going to pass by. Will it in fact provide an alternative to a breaking stock market? And we're open to that, although I think any rally that T-bonds do produce as an alternative will be short-lived and dangerous to participate in for the long haul. But right now, the only alternative is gold and the gold miners. In fact, the gold miners are beating the S&P. If you go back and look 1 year, 3 years, and yet nobody knows that. And that's fine. I just assume they not.
Oliver emphasizes that the underappreciated trend is the degree to which gold has already outperformed the S&P 500 over multiple time frames: 1 year, 3 years, 5 years, and even a decade. Despite this, U.S. investors remain deeply committed to equities, ignoring the fact that the froth driving stock prices is largely policy-induced and increasingly fragile. His historical study shows that once the Fed shifts from holding rates steady to cutting aggressively, equity peaks are rarely far behind. This is not merely a sentiment shift. It is a structural reallocation phase where capital begins to migrate toward monetary metals and away from risk assets. silver's technical backdrop is particularly compelling. After a year-long consolidation between the mid-$20s and mid-$30s, Oliver's momentum models identified a breakout in June when prices pushed above $34. This breakout, he argues, is not a false start, but the opening leg of a sustained advance. With repeated selling pressure just below the psychological $40 mark, the market appears to be coiling for a decisive breach, one that could trigger an acceleration toward the $60 to $70 range before year-end. For professional money managers, this represents both a momentum confirmation and a strategic diversification opportunity.
Obviously, the leader from 2009 to 2025 has been the NASDAQ 100, which is heavily tech front-ended. In fact, its top 10 stocks outweigh the entire rest of the index, And we know what those symbols are, all the big names. And the S&P has similar, it has those symbols also up front, the S&P 500, but not weighted as heavily as the NASDAQ 100. So while the S&P has gone up about tenfold since its 2009 bear low, NASDAQ 100 has gone up about 19-fold since its 2009 bear low. So we get 15 plus years and that kind of metric of growth in price. No time in U.S. stock market history, the last 100 years anyway, has that occurred. Duration and dimension. If you look at an M2 chart, or if you look at a Fed funds rate chart, you'll fully understand why it occurred. They pumped money, they had free money for 10 of those 15 years, and the money growth, which is now accelerating again, they're trying to save things, the things they think should be saved. The problem is when they get to that point and the stock market reality takes over and you bust the bubble, the psychological bubble, it takes over. Reality wins. Policy of government doesn't win. It fuels something else, like it did in 2000, 2002, 2007 to 9. It fueled gold. It fueled T-bonds then. So I'm looking for that again. But the leader on the downside this time will also be the NASDAQ 100, the tech sector. In fact, if you go and look inside the market, and we all hear, oh, the market's making new highs. Well, it is, it isn't. Small caps, Russell 2000, nowhere near its highs. In fact, if you look at the Mag 7, so-called, we're down to like Mag 3 now. It made new highs above the early 2025 highs. Apple didn't. Amazon didn't either. In other words, we're losing our leadership even. Anyway, I think we're in that position now where the leadership is, if you examine internally, it's not what you think it is. And this rally, momentum-wise, from our long-term momentum analysis, not looking at price, is broken. It broke during the January through March, April break. This rally, though it's to a new marginal high, I'm talking 2, 3, 4% above the January high for the S&P and NASDAQ, is not at all confirming with momentum. Momentum is still very weak looking. In fact, if you saw the momentum chart, you would see this uptrend that was broken in early 2025, hence the drop. And this rally on momentum is up on the underside of that structure that it broke on momentum. On price, it's nudging a new high. On momentum, it's bumping the underside of the bridge that it blew up. So momentum says do not trust price. And the only thing I'm kind of looking for now is that tombstone event where they finally get what they want. They get a Fed rate cut and they know more is coming. Then that's when the shock occurs, because once that occurs, if the market starts down, that's when doubt and panic set in.
What specific momentum indicators are you tracking on silver that could suggest a breakout or correction in the next few months?
It's already broken out. We had a corrective, really a sideways process. If you go back last year, remember gold in 2021, 22, 23 was a sideways market. It kept going over 2,000, they'd sell it off. Go over 2,000. So, first of all, gold never tops with a sideways top. Never. It always makes spike highs and you never go back to them. To hit over 2,000, and finally on the fourth attempt, which had been in March of 2024, gold broke through that and also long-term momentum said, you're breaking out this time. In other words, you're going to wake up after this dull period. Silver and the miners during that time had been in a staircase, underperforming gold and actually somewhat correcting down with overlapping waves. Silver broke out on the long-term momentum, a renewed, let me put it this way, not a fresh breakout, but a renewal that says, I'm waking up again. When it came up through $25.26 in the month of March last year. Or is it now? Pushing at 40. So yeah, there have been a lot of zigzags on the way up. Now, that initial surge in April took us up to a high at $32.70 and a surge, March, April, May, okay? During that time, gold was going flat, by the way. It hit a high in April last year and went sideways, just like it has done recently. Silver shot up big. Hit 32.70. Now look what happened since May last year. Downswings and upswings getting up to $35 twice, taking out that May high of last year. October of last year we got to 35. March of this year we got to 35. And it fell back down again, but basically you could draw a line sideways through silver price, through that May high of 2024, and you've been doing this, either side of it on price. That for price was a corrective 1 year sideways range, digesting its new price level, which had been in the 20s. Now suddenly it's in the mid 30s. Okay. When we came up in June, we're in August now. We came up in early to mid June, we got up over 34 again, and our momentum said, okay, you're going to blow out of this range. So you asked for a breakout, we had it. The breakout occurred when we got up approaching 35 from the underside in June, a couple months ago. Still not taking out those two highs that had occurred above 35. October of last year, March of this year. But coming up toward them, momentum says, you're gone, you're going to break out. We surged. Now they're selling it repeatedly. Again, silver doesn't top with repeated highs. 39 plus, 39 plus, 39 plus. Why? They don't want a big round number of 40, so they sell in front of it. Our assessment is this breakout that already occurred is likely to drive silver well past 50 and probably into the $60, $70 range by the end of the year, if not more. But that's our estimate. For most people, that will seem like a real acceleration. What's going on? How come I'm not in this? Okay. And I think you're already starting to see that in the gold and silver miners. They're starting to, you can have a down day in gold and they used to be down twice as much. Now they're up, quite often. I think money is starting to flow into silver as opposed to gold, a preference there. It's shifting again. And the miners versus gold. And I think between now and the year into the year, now I'm not looking for a top then, by the way. Don't confuse what I'm saying. I'm just looking for this particular surge to reach those levels. Ultimately, if silver went to $200 an ounce, it would not surprise me in the least. And frankly, if you go back in real dollar terms, factoring in the growth in the money supply, for example, and looked at 1980 when it was $50, or look at 2011 when it was $50, to match those highs in real dollar terms, we'd probably have to be $200. Just to match the real value of silver then. So, but right now, my focus is I think we're in the acceleration mode. I think gold is even now starting to hint that because it went up again into the high 34s today on the October contract. So it's indicating I'm coming up. It will lag the others though. So I want to be, again, the place to be silver, gold and silver miners. Watch
Fair
gold.
enough.
It's not the best place anymore.
If the current setup plays out as Oliver projects, the coming months could see a rare combination of declining equity leadership, broken market momentum, and a capital shift into a sector that has already signaled its breakout. The Nasdaq 100, which has led markets since 2009, is showing deterioration in internal breadth, with only a handful of mega-cap stocks carrying the index while former leaders fail to make new highs. This loss of leadership, combined with weak long-term momentum readings, undermines the sustainability of the current rally, leaving silver and select gold miners as prime beneficiaries of reallocation flows. The macroeconomic conditions reinforce this technical view. The Fed's anticipated rate cuts, far from being a market lifeline, could serve as the catalyst for equity market tops, as they did in previous cycles. With Treasury bonds no longer functioning as a reliable counterweight to falling stocks, the traditional safe haven portfolio balance is disrupted, leaving precious metals to absorb a greater share of defensive capital. If silver maintains its momentum through the $40 threshold, it could quickly draw in sidelined investors who have missed the early stages of the move, amplifying the upside through both speculative and institutional buying. Beyond short-term price targets, the dynamics in silver signal broader shifts in the global monetary system. Central banks continue to accumulate gold, while industrial demand for silver, from green energy infrastructure to electronics, provides a fundamental underpinning that gold does not share to the same extent. This dual nature, both as a monetary metal and an industrial commodity, could magnify silver's responsiveness to both macroeconomic and sector-specific catalysts. If Oliver's projections hold, the market may be on the verge of a historic repricing event that redefines silver's role in diversified portfolios. For investors, the lesson is clear. Ignoring these momentum and macro signals could mean missing one of the most significant reallocations of capital in recent market history. Whether you're focused on metals, mining equities, or macro-driven asset rotation, the months ahead could deliver defining opportunities. Stay informed, position strategically, and be ready to act before the acceleration becomes obvious to everyone.